I published a new blog post earlier today, January 15th, discussing my trades over the past few days. A link to the blog post can be found in my YouTube profile section. I will discuss gold and silver near the end of this video. While I'm still buying dividend paying stocks, I'm not comfortable in doing so based on the current stock market valuations. The buys are more of a response to the decline in interest rates that will have a significant negative impact on my income generated by treasury bills, treasury money market funds, and other short-term investments that I have. I'm not going to be able to replace the decline in income this year, interest income, with dividend paying stocks, purchases, and other income producing securities that would include equity preferred stocks, some additions to my exchange traded first mortgage bond allocation, where the yields at the current prices are close to 6%, but the maturities are after 2060, which creates a considerable amount of interest rate risk. The reason for limiting my exposure to those kind of risk assets has to do with my investment objective that emphasizes capital preservation. Since I am old-fashioned in my investment decisions, I am not going to ignore valuation measures that have played an integral part in my stock investment decisions for close to 5 decades or more and kept me out of trouble during major valuation resets similar to what occurred in 2000 and 2001. I have links to charts of those valuation indicators, which are near all-time highs, in my blog post published earlier today. As I have said in the past, a stock market or any asset class can remain overvalued for an extended period of time, and a clearly overvalued asset may continue to rise in price. My first experience with that kind of market occurred in the late 60s, with the major part of the valuation reset occurring in 1974, with a decline close to 50% in the S&P 500 and far more of a percentage decline in what was then called the Nifty 50 stocks. So I do not view the valuation metrics to be a short-term timing indicator, and may not even be one over the intermediate term. Eventually, the market will reset valuations to a rational and fact-based reasonable price range. That reset may be as large as 50%, as was the case in 2000 and 2001, or a mild bear market with a 20 to 30% decline in major stock indexes. Predicting the when of this is a futile exercise. It's just a possibility now. I know that I would only be nicked by a 30% decline in the S&P 500, as long as my bonds do not default en masse. The investor can evaluate known risk with the most important being inflation, in my opinion, moving into a persistent problematic range that I generally define as moving toward a 4% annual increase and then higher, with nothing being done by the Fed to bring inflation under control, and possibly even adding to the inflationary spiral with money creation. Until the only choice sometimes is basically to kill the economy, as the Volcker Fed did, by raising the federal funds rate to around 20% or maybe a little higher in 1980 or thereabouts, even allowing inflation to run hot for 2 or 3 years, as in 2021, 2022, will significantly damage the economy. It's not like the prices are ever going to go back down after such a period, but will only start to increase at slower rates. Monitoring consumer spending, which is still good in my opinion, is important and more important than the surveys of consumer sentiment. The job market is another important data series, and the trend there is consistent with an economy that is in danger of skating into a recession, but is being propped up now by the spending of the top 25% and by companies spending on AI. The reason for the stock rally today was a good report from Taiwan Semiconductor on AI chip spending. The tariffs wars are another major risk factor that may be alleviated, at least to some degree, by the Supreme Court holding that many of the tariffs imposed by Trump on U.S. importers were illegal, and I discussed that in today's post. But then something can happen that highlights the possibility of a widening trade war, such as Trump unilaterally imposing a 25% tariff on top of existing tariffs paid by U.S. importers for imports shipped from any country that buys products from Iran. China, which is a major buyer of Iranian products, primarily crude, has already threatened to retaliate against the United States if the Trump carries through with that tariff. And if that lasts too long, then it would be reasonable to predict a resumption of a trade war with China and possibly other countries as well. One major long-term negative impact from the Republican tariff taxes on U.S. importers is that the nations like Canada are already in the process of decoupling from the U.S. economy. Canada has been a major importer of U.S. product and services. The growing power of the presidency created by recent decisions of the Supreme Court justices and was even underway many years prior to the Republicans regaining control over the Supreme Court. Author Schlesinger wrote a book that he called The Imperial Presidency that was published around 1974. But the current impetus has the potential for undermining the independence of the Federal Reserve, and that is critical. One reason for the spike in gold and silver prices has been Trump threatening the Federal Reserve's independence throughout 2025, and that has only picked up this year with threats to criminally prosecute Powell. Another reason is that Trump may soon gain control over the Fed, either through intimidation or firing Fed members, and cause the then controlled Fed members to lower interest rates further and to embark on another massive quantitative easing program where the Fed creates tens of billions of dollars to buy longer-term treasuries and mortgage-backed securities. The Fed took its balance sheet to over $9 trillion with those kind of purchases in the last round of QE. They let their balance sheet run off to slightly lower than $7 trillion. I would need to check the number by not reinvesting the proceeds of maturing mortgage-backed securities and treasuries, but they have already decided to embark on what I call light quantitative easing by reinvesting the proceeds of those maturing securities. The last QE program resulted in over a 40% increase in M2 over slightly more than 2 years, a form of U.S. dollar currency debasement. A renewed currency debasement is certainly possible now. It even becomes more likely if Trump feels like he will lose the House and Senate midterm elections a major fear that is now driving his policies, since he knows that the Democrat control of the House or the Senate too will lead to multiple investigations of what he has done in his second term, and possibly result in multiple impeachment charges actually passing the House. I view it as more important for the House to develop a record for future generations that support the impeachment of Trump. He is not going to be convicted in the Senate. One indicator of investor concern about the U.S. dollar as a store of value, besides gold and silver prices, are the U.S. dollar indexes, and there are several of them that track the dollar's value against a basket of foreign currencies. Since Trump started his second term, the U.S. dollar index has fallen since Trump became president again, as gold has risen. And a decline in that index simply means that the U.S. dollar is losing value against foreign currencies. I do not attribute the parabolic spike in gold and silver prices this year as reflecting in any meaningful part geopolitical risk, but reflects both increased demand outstripping supply, and that's particularly the case with silver, with the demand for both precious metals being generated in significant part by the debasement of the U.S. dollar. What is the dollar's store of value when a central bank can increase the money supply by over 40% in just 2 years? There have always been geopolitical risk, and those kind of issues did not help gold, which was near $300 in December 1984 and near $300 in September 2002 after 9/11 and the start of the U.S. war in Afghanistan. There was a slight rise to around $350 a few months after the Iraq war started in March 2003. I'm taking that data from the Macro Trends website titled, quote, Gold Prices 100 Years, end quote, that uses monthly data. Precious metals and investors have typically taken these kind of events in stride, as do stock investors. A longer-term uptrend in gold started in 2004, which I would not attribute to any of the geopolitical issues that were occurring then. What happened, in my opinion, is that it started to become crystal clear that these two wars would add well over $2 trillion to the nation's debt and a significant increase in the money supply. One of the major stock market rallies in the past started after the Battle of Midway in June of 1942, even though World War II would continue to be horrific and destructive and last another 3 years or so. Investors simply formed an opinion that the Allies would win, and that was what was important long term. So they're looking through something that's a huge geopolitical risk and deciding that it's not going to be a problem long term. And I think that's what gold and silver investors do over longer term than a day or two or a week or two as well.